In this week's episode, we are going to look at different situations surrounding IRA accounts. When specifically is an IRA an IOU to the IRS? You need to know the answer to that question, and we're going to discuss that today. Let's roll.
Welcome to the Safe Money Retirement Show with your host, certified financial fiduciary, Tim Wood. Tim is a retirement and income planning expert, best-selling author of Safe Money Retirement, Your Game Plan for Success, member of the exclusive Ed Slott Master Elite IRA Advisor Group, and founder of SafeMoneyRetirement.com. Tim uses an education-first approach with clients nationwide to ensure they understand their choices in planning their own safe money retirement. Tim focuses on wealth management, retirement income, tax and long-term care planning, and asset protection and growth strategies. And now, from the Safe Money Retirement Studio in Johnson City, Tennessee, your host, Tim Wood.
I have clients contact me all the time saying, well, Tim, we've got $300,000 in this IRA or $500,000 or more or less or whatever. The amount doesn't matter. And they think that's what they have. But the topic today is, when is an IRA an IOU to the IRS? And the answer really might surprise you. That's what we're going to get into today. But first, do you already have your copy of Safe Money Retirement, Your Game Plan for Success? If not, why not? We will send you a copy absolutely free with no charge and no obligation so you can make a plan that works specifically for your situation. In this book, you're going to learn what options there really are and what you can do to help yourself plan your own safe money retirement. Give us a call right now. We'll send you a copy absolutely free. It's 800-913-SAFE. That's 800-913-7233, or just log right onto our website at SafeMoneyRetirement.com and register for your book there. So when is an IRA an IOU to the IRS? Some of y'all may already know the answer to this, but I want people to really think about this kind of in a different light, a different framework. And here's what I mean. I want you for just a moment to imagine all the way back to your younger days when you were getting your very first house and you had found the house you wanted. This was it, whether you were getting it built or buying one that was already built, whatever. This was it. This was the one you wanted. And you finally heard back from your mortgage broker and they said, congratulations, you are approved. You're good to go. But there's one catch. The catch is, we're not going to charge you interest from day one. We're going to wait to the end of the 15 or 30-year note, whatever you got, probably 30 back then. We're going to wait till the end of that note, and whatever the interest rates are then, in 30 years, we are going to back charge you all the way back to day one, and that's how we're going to determine how much interest we're going to charge you. Now, would anybody choose that option? I doubt it. I ask this in seminars. I've never had one person say yes. But you know what? That is exactly what we did with these IRA plans. We basically made a deal with the devil when we set these in motion and said, okay, we're going to take all the benefits that you're giving us. We're going to take the deferred paying taxes. We're going to take the tax creditor protections. We're going to take all of these benefits, but then sooner or later, we're going to have to pay the price. And that price is going to be whatever the interest rate is whenever you withdraw from that account. See, one thing people don't think about is if you are in a traditional IRA or really any type of pre-tax plan, I'm saying IRA, but this could be 401k, 403b, TSP, you name it, any of the pre-tax type of retirement plans. In any of those, guess who your business partner is? The IRS. That's right. Our friends at the Internal Revenue Service are now your business partner in your retirement. Because based on what the tax rates are going to be whenever you withdraw that money, right now we're at historically low tax rates. So right now the tax rates really aren't that bad compared to historically where they have been. but we don't know where they're going to be in 5 years, 10 years, 20 years, 30 years. We have no idea where the tax rates are going to be. So you literally have the IRS as a business partner in your retirement if you're in a pre-tax traditional IRA type of a plan. So what can you do? Well, we can plan for this. There's a couple of things we can do. One of the first things we can do is potentially look at doing some Roth conversions. Now, there's a lot of confusion about what Roth conversions are, and you wouldn't believe how many clients I talk to, and some with a lot of money that don't understand what a Roth is. So let's take a moment real quick and talk about what a Roth is. A Roth plan is basically a plan that you have already paid taxes on now, that as long as the plan has been in effect for 5 years, you will never pay taxes on either the principal or the growth. That's the big phrase with a Roth. Because if you did what's called a non-qualified plan, which that's an after-tax plan, like if you were funding something from a bank account or any kind of after-tax money, cashing in CDs to do something or whatever, any after-tax money, that's non-qualified. You still will never pay tax on the principal because you've already paid taxes on that, but you will pay taxes on any gains, just like you do in a CD in a bank. You don't pay tax on the principal, but you have to pay tax on the gains. That's a non-qualified plan. A Roth is different because in a Roth plan, you are paying the taxes now, but what's happening is in the future, you're not going to have to pay taxes on those gains. That's what makes Roth such an incredibly wise decision for so many of our clients. And there are plans out there that allow you every single year to determine how much or how little you want to convert to Roth. So doing a Roth conversion is by far the simplest because funding a Roth, which is something you can do while you're still working, but there are all kinds of limitations on it. The amount you can put in and how you can put it in and all kinds of limitations. Doing a conversion, almost none of those limitations exist. Doesn't matter how much money you make, doesn't matter pretty much anything. If you have got a pre-tax type of an account, you can convert all or part of that to a Roth by paying the taxes now at the tax rates now, and then you don't ever have to worry about it in the future when you need that money. That's what I'm talking about. That is the way to get the IRS out of your hair in your retirement. Otherwise, you are going to be in a situation where, let's face it, it really depends on what the rates are going to be. Let's say you're 55 right now and you're listening to this and you're planning on retiring, let's just say the average at 65. So you've got 10 years. Well, who knows what the interest rates are going to be 10 years from now? We know what the interest rates are right now. You could move that money into a plan that allows you every single year, if you've got a year where you can't afford to do any because it maybe would kick you up in another tax bracket, or you're not going to have the money to pay it that coming April, then don't do any that year. You may have a year where you can do a good percentage. So there are plans out there that allow you to do what they call partial Roth conversions. So essentially we would move the money into one of those type of plans, and then every year you would determine how much of that do you want to convert. Well, how it works at the end when you start taking money out, then the percentage that you have got done in Roth, however percentage of the account you have converted to Roth, that percentage of your checks that come in would be tax-free. That's how it works. So it allows you, if you get it 100% Roth by the time you start taking distributions from that account, all the distributions from that account would be tax-free. That is how you get the IRS out of your retirement and basically fire them from being business partners with you in your retirement. Now, it doesn't work for everyone. It does not need it for everyone, but it's something that everybody needs to know. Everybody needs to know that a traditional IRA is an IOU to the IRS because they're going to get their taxes, and it just depends on how you want to pay them. And do you want to take care of them at today's rates that we know what they are, or do you want to put them off and hope that the rates are still what they are now or maybe lower, but knowing that they could be significantly higher? Make sure you make a wise plan for you for your retirement.
Do you currently own an annuity? Do you understand what it does, how it works, and if it's suitable for your retirement plan? Some annuities have high fees that their benefits might not justify. Some annuities are exposed to significant market risk. Worse yet, if an annuity is sold without proper planning, it can cause unintended consequences for your retirement and a massive tax burden for those you leave behind. Having the right type of annuity for your specific situation is vitally important. So if you own an annuity, call us to learn more about how it works and if it's right for you. And if it's not, what your options really are. Our toll-free number is 800-913-SAFE. That's 800-913-7233. You can schedule a free consultation with Tim to review the features and benefits of any annuities or any other plans you currently have without any obligation. Call us right now to make sure your current plan is the best plan at 800-913-SAFE. That's 800-913-7233.
In today's case file, we are going to look at the story of Gwen. Now, Gwen was one of the sweetest clients I have ever had, absolutely sweetheart. She was already in her early 70s. Unfortunately, she had just lost her husband of 40, 50 something years. They'd been together for a long time. And she was coming in just to make sure that everything was in order. So we sat down, got into our fact finder. The first thing we looked at, and as most people know, once her husband passed, she then got the beneficiary. She was then the beneficiary of her husband's Social Security payment. So she got to take over his payment, which was significantly larger than hers because she had spent a lot of time at home over the years. So she was already getting that benefit. She was getting his Social Security payment. So that helped. But we looked at that. We looked at what her expenses were, and she didn't have any other guaranteed income sources. She did have a little bit of a gap since her husband had passed a few months earlier that she was just pulling from some accounts to make up the difference. Well, what we did was we looked and we tried to decide, okay, well, what can we do to guarantee that you don't run out of money? Because, I mean, if you only live, and this is me talking to Gwen, if you only live for a couple of years, sure, you're going to be fine. But what happens if you live for 15 or 20 more, or maybe 30 more with medical advancements? Who knows? There's centenarians all over the place now. So what happens and what can we do to make sure that you've got enough income? Well, what we did was we actually got her into a total of 3 plans, and they were all income plans. So what we did was at first, we got the first income plan that covered what she needed, what the gap was, what she needed to cover on a monthly basis from the Social Security she was getting from her recently deceased husband and what she needed to cover her expenses. So we got an income plan that paid her that, so she knew she was going to have that every month. As long as she's breathing, boom, she's set. Now, she was also concerned about the potential maybe of Social Security going down in the future or inflation making things more and more expensive. So we did a couple of smaller plans that are basically tagged on to that one, but they're totally separate plans, because then what she can do is in the future, whether that's 2 years from now or 20 years from now, she can turn one of those on. That's going to get her a little bit more income. And then maybe a year or two after that, if she needs more income, she's got another one she can turn on. But in the meantime, those accounts have just grown at a guaranteed roll-up rate every single year that she's deferred them. So it gives her the ability to turn on more income in the future when she needs it. She left completely happy, completely relaxed, and is one of my favorite clients I've ever had. Now, how can this relate to you? Let's say you are in a similar situation. You may not have lost a spouse or, whatever, maybe you have. If you don't have enough income to cover what you have in expenses, then there's a problem. There's something you need to do, because you can't just keep pulling from an account and hoping. That's what I call if-come. And it's an absolute recipe for disaster, because what happens if there's another major market event like so many of the experts out there are calling for? What happens if there's a global war? What happens if there's another pandemic? What happens if come? That's what you want to make sure that you avoid when you're in retirement. You want to make sure you've got guaranteed income that you can count on from a top-rated life insurance company that has been around, that is going to be there when you need them, that's going to pay that every single month, no matter how long you or your spouse live, if we set it up that way. That's what you need to think about for you. If you have got a deficit, or if you were just pulling money out of an IRA or a 401k or a savings account or wherever, and that's how you're making up that deficit, okay, well, that's working right now, but is that really a wise long-term plan? Because what are you going to do if you live 10, 20 years from now and that money is depleted? Then what are you going to do? Well, now you're going to have to live with, your brother-in-law that you can't stand or whatever. We want to make sure that doesn't happen to you. So if you have got a deficit between where your expenses are and how much guaranteed income you have coming in, give us a call because we can help you come up with a guaranteed lifetime income plan that will bridge that gap. And then maybe like she did, you might want a few others that can just keep growing for the future that we can turn on at some point in the future to give you a little bit more income when you need to overcome inflation or overcome a few more bills or whatever. That is what can help you get your own safe money retirement. Well, I'm about out of time, and I would like to thank you for listening to the Safe Money Retirement Show. If you're serious about your financial future, give me a call and together we'll get your retirement savings on the fast track to accumulate while reducing exposure to market loss. Thanks for listening, and until next time at the same time, I'm Tim Wood reminding you to stay safe so you can step into a secure future.
You've been listening to the Safe Money Retirement Show with your host, Tim Wood. Find out how to contractually guarantee that your income in retirement is guaranteed lifetime income and not if-come. Avoid any future market losses, plan for the potential of long-term care, and make wise planning choices so you can have the retirement that you deserve. Call us now for your free copy of Tim's best-selling book, Safe Money Retirement, Your Game Plan for Success. Our toll-free number is 800-913-SAFE. That's 800-913-7233. Or log on to our site at safemoneyretirement.com for more information or to request your free book. Thanks for joining us. We'll see you online at safemoneyretirement.com. The preceding information does not represent tax, legal, or investment advice. Obviously, by contacting us now, you are only taking the first step toward protecting your retirement. No information presented today should be acted upon without meeting with a qualified licensed insurance professional. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Interest and other guarantees in annuity contracts are subject to the claims-paying ability of the insurance carrier that issued the contract. The tax consequences of annuity income should be considered with the help of a licensed tax professional. Rates and returns mentioned on this program may vary based on state availability and are subject to change without notice.